What is the GSP, or Guideline Single Premium, especially in relation to indexed universal life? A lot of agents don't understand this, and that's why they don't know how to structure one correctly. So why is the GSP so important? In this episode, I'm going to give you insights into why it's important and how you can take the least amount of insurance the IRS will let you get away with and put in the most premium the IRS allows to turn an IUL policy into a tax-free cash cow to be able to earn rates of return like I have, averaging over 11%, but netting cash on cash after all costs in excess of 10%, because the GSP is very important to understand when calculating the least amount of insurance the IRS will let you get away with. Get ready. I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of people optimize their assets. And I mean increase the liquidity, safety, rate of return, and the tax benefits of their assets so that they can accumulate their money at the best and highest net internal rate of return, and to be able to get the highest net payout after all costs. That is superior to where most Americans put their money in the market in tax-deferred IRAs and 401ks. And so my favorite vehicle is a property structured maximum funded indexed universal life. And you can understand what that all means by clicking on separate videos here in this series. But in this one, let's talk about the GSP, because you wouldn't believe how many IUL agents have no clue what this is. So let's start with the milk and then go to the meat. The Guideline Single Premium, what is known as the GSP, is the amount of total premiums that will be allowed to be paid into an IUL policy during the first 11 years. And don't ask me why it's 11 years. It's been this way since the introduction of universal life in 1980. But it's approximately the first 11 years. What's the total amount of premiums the IRS will let you put into a policy based upon the death benefit to accommodate, to make sure that the sections of the Internal Revenue Code, Section 72E, which allows the money to accumulate tax-free, and then Section 7702 that allows you to access your money income tax-free anytime, not just retirement. And at the end of the day, when you finally pass away, when you die, anything left in there transfers income tax-free and will usually blossom, increase in value, and transfer tax-free. It will do that tax-free under those 3 sections of the code in compliance with 3 tax citations, TEFRA, DIFRA, and TAMRA, but you must not exceed the definition of life insurance. If you put in more money than the GSP allows, the insurance company is supposed to refund that money to you. And if you violate that and you put in more money, it's no longer an insurance policy. It's an investment. You do not want it to be deemed an investment. Why? Investments have 2 big drawbacks. They're taxable sooner or later. A maximum funded insurance is tax-free. As it accumulates, when you access the money, and when you die, it's tax-free. Nothing else does that. The second is if it's an investment, then investments not only are subject to taxation sooner or later, but they're usually subject to market volatility. And I want IUL to not be affected when the market crashes. I don't want to lose when the market goes down, but I want to benefit when the market goes up. And so I have to make sure that this is not construed an investment, because I don't want it to be taxed anytime in the future. And I do not want it to be subject to market volatility. That's an investment. I don't want one of those. Okay. And so it's critical to understand what GSP means. So let's use a few examples here to simplify this. If I were setting aside at age 35, $500 a month into a property structured IUL policy, what I want is the least amount of insurance I can get away with to be allowed to put in $500 a month for as long as I want with not being stopped. So this is where GSP comes into play. Now, So many agents, they just sell Index Universal Life at target premium. And target premium is actually a lower premium than is allowed by the IRS in order to avoid it exceeding the definition of tax-free insurance. Target premium, though, will not allow the policy to perform as a superior capital accumulation tool. What does that mean? If all you did is pay target premium into a policy, the death benefit would be much higher than it needed to be. And so what's the end result? Well, first of all, the agent wouldn't know what they're doing, and so would be lucky if you ever averaged 6 or 7% on that. When they're trained, you can rebalance and diversify and raise the gross rate of return on an IUL policy up to, 10 or 11% average. I've averaged 11.17, okay? But I can net cash on cash, retroactive back to day one, over 10%. So I'm earning a gross of 11, I'm netting 10, only 1% of my return went to the cost of insurance, which made it tax-free, which is money that would otherwise go out the window in unnecessary tax. I'm getting this insurance coming along for the ride, being paid for with a minuscule portion of money that would otherwise go out the window in unnecessary tax. What I mean by that is I'd have to be earning 15 or 16% in a tax-deferred IRA or 401k in the market. After tax, when I start taking the money out, if I pulled out 150 grand a year out of $1 million nest egg, I'd have to pay tax of 50,000 to net 100. In other words, I have to earn 15 to net 10, but then they charge me 1% on that $1 million in asset management fees. I have to earn 16 to net 10. With max funded IUL, I only have to earn 11 to net 10. So that 1% is money that would otherwise go out the window in unnecessary tax if I followed the herd, putting money into traditional IRAs or 401ks invested in the market. Well, how can I get the cost down to 1%? It's understanding the GSP, okay? So let's go back to this example. If I was talking away $500 a month, that's not target premium. You want that to be the maximum premium. $500 a month equals $6,000 a year. The Guideline Single Premium is basically you times it by 11 years. Don't ask me why. It's just the way the IRS calculated it clear back in 1980 when E.F. Hutton first introduced this. So 11 years times 6,000 would be 66,000. That's the GSP. You take 66,000, the amount of premium that you would pay in the first 11 years, and then you ask the computer to calculate what's the least amount of insurance I can get away with to accommodate a GSP of 66,000. And you'll notice the death benefit is going to be way less than the death benefit if the target premium was 500,000. You're going to end up with twice as much insurance. You're with way more insurance than you need, and that means you're not going to be able to net within 1% of the gross rate of return. You're going to be lucky to earn 7 and net 2 or 3, okay? This is huge, okay? You can't believe how many agents don't understand this. So the GSP is the amount of premium you want to be grandfathered to be able to put into the policy in the first 11 years. Now, most of my clients that are older, they would fund their policy to the max GSP, not in 11 years. You don't have to take 11 years. You used to be able to throw in that total Guideline Single Premium in one fell swoop. So if I had a client that wanted to reposition 100,000 and they were age 60, they want the least amount of insurance they can get away with. And so they would calculate what's the least amount of insurance for 500,000 in one fell swoop. And back in 1980, the minimum death benefit was about $1,250,000 for a 60-year-old. They could buy way more life insurance than $1,250,000 with a premium of 500 grand. That's not the objective. You want the least amount of insurance so that you'll get the best net internal rate of return. Because that 500,000 would double to $1 million. I had many clients that threw in lump sums of 500,000, and it doubled to $1 million within 5 to 7 years. Yep. Now their cash equaled the original death benefit. Now, this is where even later, after the year 2000, 2021, when they changed 7702, now a 60-year-old that wants to put in 500 grand can get away with just $1 million of insurance. So you can squeeze down the death benefit down to $1 million. Many of my clients, the 500,000 that they would put in would double to $1 million within, 10, 12 years quite easily. But then TAMRA came around, and TAMRA, the Technical and Miscellaneous Revenue Act, says you can no longer, after June 21st, 1988, put in a lump sum. If you do, it'll be tax deferred, but if you want to start taking out income, it'll be taxable LIFO, last in, first out. Most of my clients want tax-free income. So you want to comply with TAMRA, which means you can only put in maybe 20% a year. $100,000 the first year, and second year, third year, fourth year, fifth year. But if you put in $100,000 the first day of each year, in the fifth year, it's actually 4 years and 1 day into the policy. Now you've got your $500,000 in there. So if that's all you're going to put in, that is the GSP. I don't need to put any more money in if I don't plan on putting any more money in. So the Guideline Single Premium in this case is $500,000, and you're not going to take 11 years to do it. And the minimum death benefit is $1 million. So you calculate the least amount of insurance you can get away with based upon the GSP. The GSP is how much money do you intend to put into this in the first 11 years, even if you're going to get it all in there in 4 years and 1 day. If you don't understand this, you're going to be buying way more life insurance than you need, and your rate of return is not going to be anywhere close to what it could be if you understand how to squeeze down the death benefit. Does this make sense? So it's very important that you understand the Guideline Single Premium, how to calculate it, and then how to back into what's the minimum death benefit required. If you want to see actual examples of this and that in studying my book or in watching videos, this is what I would recommend. If you're a member of the general public and you're interested in IUL, which I think everybody should because it'll knock the socks off of putting money in a traditional IRA or 401k in the market. These are tax-free. So I'd recommend you study this book and you watch some additional videos, and you can't believe when you do that, you'll know more than 99.9% of IUL agents out there. And so if you want to do that, you'll be able to ask questions like this. And if your IUL agent doesn't know what GSP means, that's a huge red flag, okay? So here's how you can claim a free copy of this book. It retails on Amazon for $20 plus shipping. And if you buy one on Amazon, thank you. But I'll gift you one free. Here's how to claim your free copy. You simply go to laserfund.com, click on the link below, and you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. And then when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's audio and video formats there. But here's an opportunity you don't want to miss. You can schedule an appointment to talk to a certified IUL professional to see how these concepts, how a max-funded IUL structured correctly can work in your particular set of circumstances, and you'll see why they perform so much better than maybe the illustration that some other IUL agent created for you. And I'm so passionate about this. Not only should you make sure that you're working with a certified professional, but if you're an IUL agent and you're watching this video and this is an epiphany to you, you have no clue what you don't know. Because you can't be aware of something you're not aware of. And I can't believe how many agents are not even aware of something like this. This is basic to somebody who specializes in IUL. So if you're an IUL professional and you want to learn this, the first step is to belong to this coalition network I created called IUL Insiders and invest in your education. The ultimate goal inside of IUL Insiders is to become a certified IUL professional. That's not easy. It's a 100-question proficiency exam, and you must score 100% to become certified. 70% won't cut it, 80% won't cut it. And so I would recommend that you become certified if you want to do the absolute best service for your clients, if you're a professional. So this is not about me. This is about you. If you want an IUL, make sure it's done by a professional. If you're an IUL agent, make sure you become a certified professional so that your client has the absolute best chance of having the maximum net internal rate of return possible by understanding concepts like this one.